In this next video, we're going to be looking at how we're going to handle changes in the estimate of useful life and residual value. Remember, when we have depreciation, we rely on the use of estimates. GAAP tells us that periodically we should review our estimates, and if there is new information, we should update our estimates and apply them then to our uh, recording and reporting. So let's take a look at this exercise. We have a company that has a computer that they acquired in 2011. It is now 2013. Back then, the cost of acquiring this computer was $40,000. We're going to use straight line depreciation, an estimated useful life of 5 years, and a residual value of 4. So we have used this equipment for 2011, 2012. Now, at the beginning of 2013, we decide to make a change. We decide that the useful life should be a total of 10 years as opposed to the original estimate of 5. So we're going to apply this change back to the date of the purchase and say from the date of the purchase, we should have used a useful life of 10 years with a residual value of only 900. So we're going to apply these changes and make an adjusting journal entry for the depreciation in 2013, the first year that this change takes place. Remember, GAAP says when we have a change in an estimate, it is to be applied prospectively. That is from the point in time that you make the change forward. You don't have to go back and make any restatement of prior year's financial statements, nor do you have to make any type of correcting journal entry. So based on our original depreciation, under the straight line method, with a cost of 40,000, residual value of 4, and a useful life of 5, our annual depreciation was $7,200 per year. Well, the asset has been in use since January of 2011. So we had depreciation for 11 and 12 at the $7,200 rate. So at the time of the change, the balance in our accumulated depreciation account is going to be $14,400. For our revised depreciation, we're going to look at the amount of cost that is yet to be depreciated, and that is simply the cost minus the accumulated depreciation. Do not factor in salvage value at this point. Now we're going to change the salvage value from 4,000 to 900. We say in total this equipment will have a useful life of 10 years. Well, 10 years in total, but we have used it for 2, meaning it has 8 years remaining. And be careful here. There's a number of different ways you can see this in a problem. You can say 8 years from the date of the change, or you can talk about the totals as it does in this problem. So we're going to use the Excel formula for straight line depreciation. And for our inputs, we're going to use our value, undepreciated cost as of the date of the change, our new salvage value, and the new estimated useful life as of the date of the change. And we're going to have an annual depreciation of about $3,088. For the year, our adjusting journal entry will make our normal depreciation entry, depreciation expense, accumulated depreciation. We'll debit it for our new amount, and that's our journal entry using straight line depreciation. Let's continue on to the second requirement, which makes the same assumptions, but instead we're going to use the sum of the year's digits. So we set up our problem. We've depreciated the asset for 2 years. Remember, in sum of the year's digits, the annual depreciation will differ from year to year. So we have to determine the accumulated depreciation as of the end of year 2. Of course, in the real world, we would just simply look at the accumulated depreciation balance in our general ledger. But here in textbook land, we have to calculate that. So our annual depreciation for year 1 we'll determine using the sum of the year's digits formula in Excel. Again, we have our cost, our original salvage value, our useful life, and for our period, this is the first year, so it's 1. Our annual depreciation for year 1 is 1,200. That's our depreciation expense. The balance in our accumulated depreciation account for this asset is also 12,000. Again, we'll use the same function for year 2. We have our cost, our salvage value, our useful life, and we are in the second period of depreciation. And our depreciation for year number 2 is 9,600. That's our depreciation expense. The accumulated depreciation at the end of year 2 is our opening balance plus the expense for the year. So when we make this change, we now have an accumulated depreciation of 21,600. So our undepreciated cost is the 40,000 minus the accumulated depreciation, or 18,400. We have a new salvage value, and just as before, the remaining useful life is 8 years. We said the original useful life should have been 10 years. We used up 2, so we have 8 years remaining. Now we're going to start a new depreciation schedule from this point forward. So instead of this being period 3 for our sum of the year's digits, we're going to reset this to period 1. This is the first year of our new revised depreciation. So now we're going to use the sum of the year's digit formula. Our cost will be our undepreciated cost, our new salvage value, new useful life, and again, we revert back to period number 1. So for year number 1, under the accelerated sum of the year's digit method, we're going to recognize depreciation expense of 3,889. That will increase our accumulated depreciation by an equal amount. The new balance in the accumulated depreciation will be the prior balance, 21,600. That does not change based on our changes in salvage value and useful life. So at the end of year 3, our balance in our accumulated depreciation account will be 25,489.